Welcome to this video that will teach you in 5 minutes ways to retire as a millionaire using common techniques. If you're between the ages of 25 and 30, you might think that retirement is still a long way off, but it's never too early to start planning and investing. In fact, the earlier you start investing, the more time your money has to grow and compound. In this video, we'll discuss the best investment strategies for young adults who want to achieve their retirement goals of at least $1 million US. We'll cover everything from budgeting and risk tolerance to index funds and real estate. So, let's get started. Before we dive into the specific investment strategies, let's take a moment to understand why it's important to start investing early. For example, if you're currently 25 years old and you want to retire at age 65 with a goal of having $1 million in today's dollars, you'll need to account for inflation over the next 40 years. Assuming an inflation rate of 2% per year, you'll actually need to save around $2.2 million by the time you retire. If you make $80,000 USD a year and save 15% of your income, $12,000 USD per year, and you earn a 7% annual rate of return on your investments, you could potentially have over $2.2 million saved by age 65, which should be enough to achieve your retirement goal. The first step to investing is to establish a budget and prioritize your savings. For example, if you make $80,000 a year, you might allocate 50% of your income towards necessities, e.g., housing, food, utilities, 30% towards discretionary spending, e.g., entertainment, travel, hobbies, and 20% towards savings and investments. The next step is to determine your risk tolerance and investment goals. For example, if you have a high risk tolerance and a long-term investment horizon, you might choose to invest in higher risk assets, such as individual stocks or growth-oriented mutual funds. On the other hand, if you have a lower risk tolerance or a shorter investment horizon, you might choose to invest in more conservative assets, such as bonds or dividend-paying stocks. One of the best investment strategies for young investors is to invest in low-cost, broad-based index funds. For example, you might consider investing in a total stock market index fund or a target date retirement fund that automatically adjusts the asset allocation based on your target retirement date. These funds provide exposure to a diversified portfolio of stocks and bonds, which helps to mitigate risk and increase returns over the long term. Index funds are also low cost, which helps to reduce fees and improve overall returns. Another effective investment strategy for young investors is to invest in individual stocks or mutual funds that align with their interests and values. For example, if you are passionate about renewable energy, you might consider investing in a clean energy mutual fund or individual stocks of companies that are leading the way in renewable energy. By investing in companies that you believe in, you can help to support causes that are important to you and potentially earn higher returns. Real estate is another investment option to consider. For example, if you have a significant amount of savings and are comfortable taking on debt, you might consider investing in a rental property or a real estate investment trust, REIT. While it requires a significant upfront investment, real estate can provide a steady stream of rental income and potential capital appreciation over the long term. Real estate is also a tangible asset that can provide a sense of security and stability. Finally, it's essential to continuously monitor and adjust your investments as needed. For example, if you experience a significant life event, such as getting married, having children, or changing jobs, you may need to adjust your investment strategy to align with your changing financial goals. As you get closer to retirement age, it's wise to shift your investments towards lower risk assets that can provide more stable returns. It's also essential to review your investments periodically and make any necessary adjustments.